All right, everyone. Big news coming out of Moody's today. Few major U.S. banks are being downgraded on worsening outlook of the economy. All right, let's get into it. As we can see here, this article from Reuters, the ratings agency Moody's has downgraded several U.S. mid-sized banks, warning that the credit strength of lenders will likely be tested by funding risks and weaker profits. What does that mean for average consumers who put money into these banks or borrow either through a loan or a mortgage? We'll get into the details there. For now, we can see here what are the banks that were downgraded by Moody's. We can see Pinnacle Financial Partners downgraded to Baa2 from Baa1. Outlook here from negative from stable. We have Fulton downgraded also to Baa2. Outlook is negative. Prosperity Bank downgraded to A1 from Aa3. Outlook is slightly more positive, stable. Same thing with the next three banks here. Stable outlook, downgraded to A3, to Baa1, and also Baa2. On the other hand, Old National Bancorp, downgraded from Aa3 to A1 with a negative outlook. Citizens Financial Corp, changed from stable to negative. The rating did not change, Baa1. M&T Bank Corp, stable outlook, downgraded to Baa1. Commerce Bank, stable outlook, but downgraded from A2 to A3. Regions Financial Corp, changed to negative from stable outlook. No change in the rating. Simon's First Financial, negative outlook, affirmed at Baa2. Ally Financial, negative outlook. Bank Deposits, affirmed at A3. So what does this all mean? So quick summary of these credit ratings. We essentially have these three credit agencies that provide an outlook for companies, not only banks, but companies overall, on their financial health and how healthy they are to service their customers, and also when they issue debt or bonds, how likely it is to pay back their customers. So these ratings that we had talked about with Moody's, we have long-term and short-term ratings. We can see how these ratings that were just said about those few banks translate to the rating description. So if you have ratings that are in the A category, they're considered prime, high grade, and upper medium grade ratings. What that means is these are typically fairly stable, fairly healthy, and there isn't as much risk of a default or a bankruptcy. If you were to invest in one of these bonds by these companies, you can reasonably be sure to get paid. And there's very little risk of bankruptcy, or in this case, a bank. If you were to put your money in a bank, there is a reasonable assumption that the money will still be there as part of this rating. We've talked about a few of these banks with these Baa1 or Baa2 ratings. What that classifies is lower medium grade. That means the chance of something happening the risk is higher than what you would find in the A category. What this also means is if you are a bondholder, if you're an investor, you're looking for investments from these banks, whether it's an interest rate, whether it is a bond in the bank account, or you're purchasing an individual bond, because the risk of default or the risk that something might go wrong is higher, the interest rate expected for these also needs to be higher. One thing to note, as you can see here, regardless if it's AAA down to Baa3, it's all considered investment grade. What that means is this is still something that is fairly stable. Obviously, AAA is much stronger of a rating than Baa3, but the likelihood of default or bankruptcy from these banks is fairly low. Once you go down to Ba1, that goes into the category of non-investment grade, aka high yield bonds, you might heard of that, or junk bonds. And here you can see, if you were at CAA1, there are substantial risks to the viability of the business. Whereas you can see if you were at C, you're in default. You're not going to get the money back from the investment you've made. So as we can see, it tops down at Baa3. We can go back to see what the categories are for these companies. It looks like the lowest rating is a Baa2 across the board. Lower medium grade. There is a higher risk of something bad happening, but in the grand scheme of this chart, the possibility of default or the bank not existing is still lower. I would say there is not a lot of risk in the money that you've put into these particular banks. Number one, it's still in the upper half investment grade rating for these banks. Number two, as you know, any savings that are $250,000 or less is fully insured by the FDIC. So in case something does happen, as long as you have $250,000 less per account, your money is safe with the government. So I would say there is probably not a lot of risk even with the ratings. However, if you are an investor in these banks, if you have individual bonds with interest rates, because of the lower rating, the expectation for these interest rates are going to go up and the value of the bond is going to go down. So if you were looking to sell a bond that you purchased from one of these banks, the price of the bond will go down and you will take a loss on that. So if you have the opportunity to hold a bond to maturity and get the full value of the interest, I would suggest you to do that. Moody's also provided additional outlook for these banks, and these are some of the largest banks we have in the US. Bank of New York Mellon. There is a review for downgrading the long-term issuer ratings. They haven't downgraded the rating, but they are reviewing it to see how the operations are going to go over the next couple of months. US Bank Corp, State Street Corp, Northern Trust. These are systemically important banks that hold a lot of money within the country. As you can see here, the list here on the top section, these are more regional banks. The impact of a failure for one of these banks wouldn't be as large as if it was a Bank of New York Mellon or if it was a State Street Corp. We'll have to see how it plays out. if we're raising interest rates yet again and what the impact would be for these banks. That's all for today. Thanks for listening.